Hello, everybody. Um, yeah, so here we are. It's April 4th, and we're witnessing absolute pandemonium in this environment. You know, Scott made a really good point. I was chatting with him a little bit earlier, and he said, everybody did not recognize that Buffett left the party very, very loudly, and everybody kept dancing. And we knew about what was going to be happening with tariffs. Everybody kept saying, "Oh, it's not going to be bad. It's not going to be bad. It's just negotiation." And sure enough, they're doing exactly what they said they were going to do. They were going to implement tariffs, and now the big question is this negotiation or is this actually part of fiscal policy here in the United States? Are they actually going to try to pay down the debt through tariffs? And that resultantly, a lot of people are confused. A lot of people are asking questions. But once again, at the end of the day, the key thing, the focus here, is price and what is happening and what is the S&P 500 doing and where is it at key technical levels and what should people be doing right now? How do we assess this? Well, the reality is we are not going to know until Monday or Tuesday. Tariffs go into effect tomorrow. We're going to break this stuff down. I'm going to walk you through the combination of the tariff impact, but also Federal Reserve Chair Jerome Powell just spoke not too long ago, and this is a really interesting conversation, right? Because we're witnessing U.S. v. China. We're also witnessing U.S. fiscal policy against the Fed. Now, this is a really interesting thing for people to think about because in the last few years, going back to the last type of environment that we had like this, the last time that markets were hair on fire red, when was that? When was that, everyone in the chat? Do you remember when this was? Do you remember the last time we started having these very conversations? The last time was not 2020. The last time we did this was 2022, right? 2022. Stressless, 911. Got it? Somebody else got it just before that. It was 2022. And it was the bottom of a huge sell-off that transpired, started November 2021. Now, if we go back to 2020, we had a massive amount of capital injected into the market back in 2020 during the COVID crisis. And once again, as I say, somebody did say I said, nothing good happens when the S&P 500 falls under its 20-day moving average. Now, someone said stocks get cheaper. That is a good thing. But what I'm talking about is on the big macro perspective. Something is typically going on. Something is possibly going wrong. And in most cases, we know what it is. And in the case of COVID, we knew it was COVID. And in the case of what's happening right now, we knew that it was tariffs. But we didn't know why the S&P 500 was falling under its 20-day moving average back here in August of 2022. Well, earlier that year, 2021, put everything into perspective, pour trillions of dollars onto a market. Everybody starts buying everything. Everybody's completely and totally going wild. We have this CAPE ratio up at 38 at the end of November 2021, and we start to sell off when the Federal Reserve started to have to raise interest rates. And we had these false moves along the way. Lower highs, lower lows. March 2022, the expectation at that point was the Fed was only going to need to raise interest rates by 25 basis points or 0.25% in order to avoid inflation. And boy, were they wrong. But while all that was going on, we sold off and we had this move right here, and that was late August 2022. That was the onset of the gilt crisis. And that is a crisis that transpired in England as they raised their interest rates, and they did so aggressively. The value of the gilt bonds began to drop precipitously, and pensions, if they needed cash, needed to sell these bonds to raise cash at a almost liquidation price, which set off a major crisis in England. Liz Truss had to resign. And then what happened, the Bank of England effectively said, we can't let this go. We need to start buying assets back. And they started to buy bonds back. And while all that was going on, everyone thought, well, the Federal Reserve in the U.S. are staying out of it. We're going to continue to tighten our belt. We didn't. We started selling short-term T-bills into our bond markets. And when we did that, that is jet fuel for the repo market. And that increases credit, leverage, and risk in the financial system. And I'm going to explain to you why that matters and why this is now a debate and a question of fiscal policy versus the Fed. Because while all that was happening with U.S. Treasury bills, the Federal Reserve created lending programs in March 2023 during the Silicon Valley banking crisis. Now, the Fed will say that was not quantitative easing, and technically it was not. They did not buy assets and put them on their balance sheet, yet they did swap assets and put those assets on their balance sheet. The point of this is the Federal Reserve has been providing support to the financial system since 2023. The Treasury Department was doing so since 2022. And a lot of people didn't even know it was happening because they thought that we were tightening because interest rates were high and because there was this broader issue involving our debt that they were just going to let the bonds roll off the balance sheet. But that's not all the central banks do. There's a lot of things that the media just does not pay attention to. And eventually people catch on. And what happened, the markets continued to rise through this year. We had ample financial support. We had ample quantitative support. We had ample fiscal support. And that support is gone. That support has disappeared because there is no longer a significant amount of selling of T-bills into the market. And in addition, the Fed is not coming to save this market. Okay? The Fed is not going to be able to step in and start buying assets unless they are willing to start allowing inflation to potentially remain constant. And if that is the case, stagflation becomes the big fear. We have witnessed a dramatic sell-off. 604 on the SPY down to 513 in roughly 6 weeks. Again, nothing really good happens when the S&P 500 falls under its 20-day moving average. And we had two warnings on this. February 21st, before I got here to Theo, but we were still talking about it in the mornings. And then last week, another move under the 20-day after a small pop. And I refuse to admit or believe, forgive me, I've refused to believe that people don't know what's going on. I mean, we saw selling 4 weeks before the COVID shutdown. We saw a lot of selling last week before these things were announced. So in this environment, I just continue to remind people, I don't believe in consequence in the markets. Consequence. Gosh, I don't believe in coincidence in the markets. So we are selling off very dramatically. And now the question is, right, we just witnessed the Federal Reserve and the Treasury Department kind of working together in the last 3 years, 2.5 years, to provide support to our system. And now the Federal Reserve is boxed in because the fiscal policy is going in a different way. And this is the conversation that we had today, right? Federal Reserve Chair Powell issued the strongest warning yet. About the economic impact of President Trump's sweeping tariffs, right? He says the tariffs are highly likely to generate at least a temporary rise in inflation. Now, that's subjective. Keep in mind, there are two elements to this. Prices will go up on things that are imported. And as we discussed yesterday, the importer's paying that, right? The agent of the importer will pay that. It's not necessary. It's a question of whether or not it is passed on to the consumer. But things that we do not grow here, bananas, we don't really grow bananas here. We're going to pay more for those. But things that are comparable, comparative goods, that's the question, right? Will automobile companies that produce 100% here, or will tell whatever it is that we produce, and we don't produce a ton of stuff, right? We used to make a lot of things in America, but now we reach into one another's pocket. That's a line from season 2 of The Wire, for anyone who wants to watch. This is where the debate between the fiscal policy and the Federal Reserve come into play. 10% tariffs on all imports start tomorrow. Now, why does this matter, right? The Trump administration has unveiled what Fitch has just called the sharpest escalation in U.S. tariffs going back 200 years. They are steeper than Smoot-Hawley in 1930 for historical context. Those were tariffs that went into effect to protect the U.S. economy back in the 1930s, and then a year later, global trade fell by 60% in 1 year. So tariffs have a dramatic impact on trade. Dramatic. 10% blanket tariffs starting Saturday with higher tariffs coming on the 9th. Now, the Trump administration has said these tariffs are reciprocal. How they calculated it is a little different and unusual, but they are saying that they are only tariffs on things that we are taxed upon when we send exports to those countries. So if Europe has an automobile tax of 2.5 to 3%, we're going to charge 2.5 to 3%, even though the metrics were a little bit different. The reason this market is selling off the way it is today is because China announced retaliatory tariffs of 34%. Now, Trump upset about this because maybe he was trying to do a negotiating tactic, but the reality is a lot of the companies in the FANG group, upper echelon of technology companies, they have a lot of exposure to China. Companies like Wynn Resorts, right? Wynn Resorts is not a company that's going to be necessarily engaging in exports, but they are a casino company with a significant amount of exposure to Macau. And if that is the case, will they face new pressures in the future because they are an American company? That is something that has to be considered as well. Apple with exposure to China, companies with supply chains. And the question for people at the end of the day is, why is this happening in the first place? What is going on? Well, there are three people who are primarily involved in this, right? Trump involved, Bessent, who is our Treasury Secretary, and Howard Lutnick, who is our Commerce Secretary. Those are the three big voices. And then you have Peter Navarro at Trade. The argument is pretty simple. And this is an issue that involves the US dollar. This is something that people don't talk about much, but it is the nature of the US dollar itself that is the underlying challenge. The dollar is extraordinarily strong globally. It is also, paradoxically, was very, very strong on the onset of quantitative easing that started to happen back in 2013. Interestingly enough, quantitative easing, which was the process of the central bank buying assets and putting them on their balance sheet in order to keep interest rates low, was the largest and most distortionary intervention that had ever been made in global bond markets, ever. And it all comes down to the Fed's balance sheet. The Federal Reserve balance sheet, when the Fed did not have anything on its balance sheet, or roughly a couple hundred billion back in 2007, 2008. I need to actually find the image of this. There you go. There's the Fed's balance sheet. Roughly 6.7 trillion in assets at the moment, but QE starts here at 2.3. And the interesting thing about QE is that it favored U.S. markets. The dollar actually rose from this because capital flowed into the United States, but the dollars got more expensive and investors got saturated. This was not something that had just been occurring for a short period of time. Since we went off the gold standard in 1971, it changed the trajectory of the U.S. economy. And if you go to WTH happened in 1971, it's a website, it just shows that all these crazy things started to occur in the U.S. after we went off the gold standard. In 1993, we started to do a number of other things. We started to engage in quantitative easing, or inflation targeting. We started to allow CEOs to get compensated in stock. We started to reduce our supply side policies under Al Gore. We put significant focus on things like bonds in the mortgage market. Rubin came in and he basically deregulated everything in finance, and he single-handedly may have caused the entire 2008 crisis by himself. And then you had the start of the pacification of the U.S. economy, which was adding ETFs. And then you start QE in 2011. And basically all of these policies are what have gutted the U.S. economy of manufacturing and building things here. And there's something called the Cantillon effect, which is where when the United States creates credit, the relationship between top 1% and credit creation in the United States, every time that there is new money created in the system, and I'm seeing if I can find this chart here. Unfortunately, it might not be here. Every time that we print, there is a direct relationship between the assets of the top 1% and the new credit creation. And what happened is this is called the Cantillon effect. This is where Wall Street and Washington make a ton of money because they own assets already. And when you add capital to the system, you end up inflating the valuations of real assets, stocks, housing, everything else. That is what they're arguing needs to end. And in the process of this happening, the Fed, which has done nothing but create credit since its inception, they are stuck in a box at the moment because the argument is, okay, we're going to bring things back to the United States. Whether or not that works, I don't know, but I'm just pointing out what is going on at this exact moment. So when the Trump administration slaps these tariffs on and argues that companies should move back here to the United States, the question then becomes, well, that's going to be difficult because wages are high. Well, if tariffs are in place, then perhaps the competitive advantage that locations like China have will be nixed, and companies would want to invest here, build here, and then maybe we can address some of the underlying security problems we had during COVID, which included a lack of pharmaceutical drugs, lack of masks, and basically broader supply chain problems. This is the argument. I don't know if it's the right argument or not. I've been in economics long enough to understand that there is an argument on every side, and I've been around long enough to understand that every time that I think I'm right, I'm wrong. So in this environment, you hear this, but we have to play the game that we are handed, and the system relies on cheap money. The system relies on continuing expansion of credit. And the system as it is being threatened. And resultantly, you are seeing all the funds and all the companies who have been playing by the same rules for 30, 40 years, they're exiting. And a lot of the people who don't know that this is how the game is actually played, they're standing around with their hands in the air, looking up to the sky saying, why is the market down the way it is? And they're not understanding it because the media doesn't talk about this. Nobody talks about this. It's too damn complex. I've spent 16 years of my academic career on it, and it's considered fringe to even have a conversation about it. It's one of those things that people whisper about in bars, but everybody knows it. Everybody knows the reality of it, and I pointed it out for one simple reason. As I was pointing out, there's a reason why, at the end of the day, the top performing ETFs of the day are things that didn't exist 5 years ago. This is all financial engineering. This is all financial innovation, right? 25% gain on an inverse gold miner ETN. Do you know what an ETN is? It's an exchange traded note. It's not an ETF. It is credit exposure, and it is leveraged, and it is inverse, and it is on gold miners. These are not things that are going to put food on the table. These are just things that exist, and these are things that people are trading millions of things, right? 100 million shares today of T-Rex inverse daily Tesla target. Why? Because this is where money goes when credit is expanded and people need things to bet on. And as I joked earlier today, some hedge fund managers saying, well, I use the TSLZ in order to leverage, protect myself against leverage in my Tesla daily trading. Why are you doing that in the first place, right? Like what is happening in the markets that justify, that type of kind of rocket fuel trading? But this is what exists, and this is where money has been going. And again, at the end of the day, the people who create this stuff, they're taking 2% annually. So they're getting paid. But like, this is not the stuff that's putting manufacturing back in Cleveland. So this is kind of where incentives lie, and this is where people are getting paid. And it's just important to point out that, like, this is kind of what the big debate is about at the very high level, macroeconomically. So as we look at this, right, it is very, very, very concerning because there are rules in the system, in the broader system, and the markets are reacting because the markets operate under the previous way that they know how. Money flows in directions based on incentives, based on how people perceive what the future is going to be. And the JP Morgan economists have placed a 60% odds of a global recession. But keep in mind that a recession is based on GDP, gross domestic product. And GDP here in the United States has been roughly 3% for 2 years, but we've also borrowed 7% of GDP in order to get to 3% of GDP. So we don't talk about that much either, do we? 7% borrowed against our future in order to create what is known as Keynesian growth, where you borrow and print and spend. And so long as that spending is nominally above where it was recently, you're not in a recession. But the underlying issues still exist. And this has been building and manifesting for 15 years. This has been actually longer than that, 17 years, since the 2008 crisis. So consumer prices will rise, particularly for automobiles. The cost of things that matter will likely go up, but the cost of things that mattered have already been going up because of the money printing for 17 years. A lot of people trying to understand what inflation actually is, I always just go back to a very important thing that's called the Chapwood Index. People have been told for a couple of years that, oh, inflation's just 3%, right? The Chapwood Index is an independent group that tracked cost of living in the United States. All they did was go around to various cities and trace how much money was being spent and on what. And they basically just said, we're going to take the top 150 things that people buy, and we're going to track the prices in after-tax dollars, and we're going to do it in the top 50 cities. And they found out that between 2017 and 2023, at in New York City, the average cost of living increase, which is what CPI is supposed to be, was 12.1% a year. A year. And during these post-COVID years, 2021 to 2022, that point where inflation really started to kick in, it was in the high teens. Chicago. So again, this is just looking at the numbers, tracking the numbers of what people bought. So again, we were printing a lot of money. The cost of living continued to rise. And now, the Fed has raised rates, yet the Treasury Department last 2 years kept supporting the system. Our inflation numbers are all over the place. We're in a very difficult, precarious position. And it's going to be a period of difficulty for investors, for trading, for everyone who want to do things really, really fast. They're looking for answers really, really fast. And the reality is when these events transpire, 2011, 2015, 2018, 2020, 2022, it takes some time for these things to petter out. And the risk of stagflation, that's something that virtually no one under the age of 45 has ever experienced before. What it means, how you protect yourself, what a bear market looks like. And a persistent bear market, not one that lasts 9 months and then they turn around and start to pump money back into the system. Not one that lasts 30 days like during COVID, and then they turn around and drop $4 trillion from the sky. I have to be the person who's going to tell you they're not going to just drop money from the sky unless they have to bail out the basis trade, which I don't want to get into right now, or unless something really significant breaks. But I will tell you that I know personally, when that day comes, when that day to address what is broken comes, I know what the pattern is going to look like to say, okay, everybody, you can get back into the pool. If you've been sitting in cash, I've called it down to the day 4 times. And it involves the 20-day moving average. It involves bottoming out. It involves insider buying at massive levels. And it involves policy changes. Those 4 things. And we here at Theo are all over this. I've been here 2.5 weeks. I mean, everybody knows what I'm talking about, which is wonderful. But I mean, Blake's on top of the options. You have Brandon talking ghost trades. You have Jeffrey Bierman. He's talking about he's on top of the Fed more than I am, and Don's just continuing just to absolutely hit everything on the head. He's going to be joining us in a moment. It's really, really great to be in an environment where you can have a candid conversation about all of this and then say, all right, we've seen this before. We've been here before. How do we help our audience and have these conversations that are very candid? because CNBC is not going to talk about this. Barron's isn't going to talk about this. I've been doing this. I was a financial journalist, went to school to study journalism. My dad would love that money back, but I learned what isn't done. I learned what isn't done. And you're hearing what Powell is saying, and I'm trying to translate it, that these are prepared statements, right? We face a high uncertain outlook with elevated risks of both higher unemployment and higher inflation, Powell said. The Fed must balance its dual mandate of maximum employment and stabilizing prices. That's not the Fed's mandate. The Fed's real mandate is to provide a backstop to the global financial system in the event that there is a liquidity crisis. That is what the Fed does. Doesn't matter what the employment is. It doesn't matter what inflation is. If they have to step in and do something because something serious is broken, they will do that. They did it with the gold crisis. They did it with COVID. They helped contribute in 2015 with China. They helped contribute with the ECB, and they obviously contributed in 2008. You're not going to hear people say that. So you're looking for a pattern. You're looking for knowledge and knowing I can be confident right now that I've been building my cash, or what is the date that I can step back in and buy the exact same things that I have owned the whole time that I'm passionate about, the stocks that I love, the companies that I love, that I can come back in and say, all right, I can put this money to work on the exact same things. And again, it all comes down to those four things of insider buying, of certain moving averages, of you're going to see option activity that's going to be very unique. You're going to see policy changes. It might be a little while, but while this is going on, again, those changes are going to come because they come every time. They cannot let it break completely. There is a slogan called print the money or start a revolution. They're not going to let it completely go, but it's going to be a period of time. It's going to be tricky. So I just want to point this out. Don's going to be joining me in a moment. The political dimension, right? Trump posted on social media calling for Powell to cut interest rates. There is tension between the White House and the economic agenda and the Fed independence, obviously. Powell's diplomatically avoiding the confrontation. Fed will meet on May 6th. And the key questions right now, and Don's going to join me soon, and we can discuss these questions. Can the Fed combat stagflation if it emerges? Because the Fed will have to address both unemployment and inflation at the same time. That's very, very difficult to answer. What are the things that you need to own in the case of stagflation? Well, that's what we're going to talk about next week when we talk about bear markets. Will these tariffs accomplish Trump's stated goal of bringing manufacturing back to the United States? That is still up in the air. How might these economic tensions affect international relations beyond trade? Well, right now you can see that a lot of people are upset. But again, the United States economy is replying to existing tariffs, and the United States economy is addressing, economic perceptions and doing the exact same thing tariff-wise that we are paying in other countries. And then what sectors and consumer goods might see the immediate price increases? There's Don. There he is.
I'm here.
What's going on?
It's been a busy morning.
It has.
I just started. It kind of mellowed out a little bit, and it finally gave me an opportunity to start to execute some trades in. So I've been over here. I'm what I would term a rolling fool, and I mean that because taking positions and rolling them out in time, the volatility is not over today.
No.
There's no easy way to say this, but this thing is not. It's not letting us out. Not today. Not going to let us out of this thing today. There was a chance like we were going to rally a little earlier, but not exactly feeling warm and fuzzy right now. But you got to roll with it. Like literally, like I know I'm like talking about rolling here, but you got to kind of roll with some of the punches. And I don't have risk. I don't have like a lot of exposure right now to the downside, but there's a couple of like little positive things going on. Like actually, it's funny what you have up there because it's almost exactly what I look at. I'm looking at an advanced decline line, which I'll show on my screen in a few minutes.
Sure.
And in the S&P 100, it's a quintessential, like full correlation, all down day. That's actually kind of a good sign because the market's no longer functioning where we're trying to rotate and rotate and rotate, or I always scream, You remember that? Do you remember that Friends
Yeah,
episode
I
like
do.
forever
I do.
ago?
Right.
Anyway, it's no longer like trying to rotate. Now it's every kind of, it's man, woman, and child for themselves.
Hmm.
But that's how you hit capitulation. Without correlation, there is no capitulation, and we're correlated right now.
Right.
It's ugly. It has to get ugly. You got to feel like there's no tomorrow for this to kind of be over.
Hmm.
And there was multiple times today, and I'm like, wow, like, you were mentioning like 2022, and yeah, I actually tune into you. But I've been getting in here like 5:45 in the morning too. It's sad. I'm Pacific time right now, but I've been in here early. I was listening to you a few minutes ago, and you were talking about 2022, which was it was extreme, but it didn't have this kind of sudden feel to it.
Yes.
This is like COVID had a feel to it, like yeah, you were more worried about your own health than you were the market. That was a little bit of a different
Hmm.
feel. This is yeah, this is fast. And
It
it's
is. And
yeah,
its quality is also selling off, which I think is one of the things that is a little interesting. As I noted this morning, I was talking about the fact that, we've had right now we have within the S&P 500 today, we had 10 stocks hit all-time highs and 52-week highs.
yeah.
So, right, like this is what's working even in the face of just chaos, right?
You can smoke
And
it, drink it, it
right,
works.
right, and right, and light up the lights in order to do it. But I mean, you're seeing those stocks, those 52-week high kind of heading momentum style names, they're starting to break down, sell off a little bit today. Energy transfer, which is, I have a lot of exposure to energy transfer. How are we going to keep the lights on in America without moving natural gas to manufacturing? It is selling off. So you're seeing kind of some levels of,
I will say
soft
this.
capitulation.
Yeah, no, there's a few stocks that have like possibly hit rock bottom, and there is some bottom fishing going on right now. And I'll name a few.
Yeah.
Nike,
Yep.
Nike's actually higher today. Home Depot, like
Hmm.
Home Depot, really? That one actually shocked me when I saw that Home Depot is actually higher in the day. And probably one of the most odd ones is Ford. They took their beatings early, meaning
Correct.
that, and so to give people a feel like for what that capitulation looks like, you look at something like Ford. Again, they took their beatings early on. Um, it's off the lows. It's actually higher today, nominally higher, but
Hmm.
it's higher today. And but that's what it looks like. That's how it kind of starts. There are people that are stepping in right now and be like, that's not a half bad deal at these
Yeah.
levels. The Home Depot one actually kind of surprises me. The home builders got hammered the other day, and I'm looking
Yes.
at it on my screen here. The home builders,
PHM,
yeah,
Pulte's.
but like, so the XHB, which is the
Yep.
ETF for it, um, is up considerably. And again, this is where I'm just pointing out, all right, at the very minimum, you have a short-term kind of bottom definitively in.
Hmm.
Question is this going to catch fire and spread through the marketplace?
Right.
My inclination, you got to get crazy. You got to go to the downside a little bit here.
Hmm.
Let's get crazy, and then we might get a little bit of a bid back. But these are days where you're like, I look at the clock and I'm like, wow, there's still 3 hours left. Like
Right.
it's so I set alerts every night because I am much more the trader than I am the investor.
Hmm.
And at about 3:15 in the morning, my alerts go off. And like I have my phone set up where if the alert goes off, like it bypasses silent mode.
Hmm.
So the alert goes off. And even my wife, she's like, "Well, it must be serious."
Right.
you know, she's
Right.
she's been trained after 15 years. Those alerts haven't gone off that many
Yeah.
times in like 15 years. And I actually, before I even grabbed the phone, I was like, oh, China retaliated.
Right.
Did it in the
Right.
middle of the night, and we were kind of off to the races. But again,
Y-
nobody's going to worry about that come Monday.
One of the things that you said, you're more of a trader, and I would probably categorize myself as I'm a trader, but I focus kind of more long term of like how can I enter specific stocks that I want to own. But a lot people who haven't been through this, or maybe this is their fifth rodeo, this is one of those days, one of those reminders of you have to go through your portfolio on a regular basis, and you have to say to yourself, am I willing to hold this stock through this type of environment? I went through like my 401k
Yeah.
and I was like, why do I own Riot Blockchain?
Oh
Like,
boy.
why did I have any shares of that? Like, oh, well, it's a really long-term compelling. No, 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 no. That's not quality. That's like, I didn't get hammered on it, but like, I didn't have a ton of it, but I owned enough to be like, well, that's stupid. Like, there's nothing compelling for these types of things. And, as we start talking about bear markets and, where money will rotate, we're seeing money move into the defensives, obviously. And we're seeing a lot of money pour into things like the IEF, which is the 7-year Treasury bond, which has just been a nice stair step ladder up for the last week. The IEF, people are going into duration, 7 to 10 year bonds, because as they buy these and yields decline, these bond values go higher and people are making off on it. So you're going to see a lot of money continue to likely pour into that, and that's going to be a trade. That's going to be a function. And I think at the end of the day, you just got to think a little bit about if you bought something on speculative, particularly tech, that's completely unprofitable. Well, you might get beaten up here and you might have to take your licks on it and you might have to move to cash on some of those positions. But let this be one of the most invaluable lessons you have, because I learned that lesson during the dot-com bubble. I don't typically own crap anymore. And it's easy to get swept up in the headlines of stuff. At the end of the day, capital efficient companies that have really strong quality and value metrics, things that you can trade around. I know Jeff's been talking about that. And,
Sure.
again, at the end of the day, like, are you willing to hold it through this? Because what we are seeing, John, is that a lot of people who claim they are investors really are traders, because they're dumping a lot of stuff today that otherwise would not have been dumped if they were thinking long term minded.
Yeah, the irony of that too that they're dumping today is, look, that's exactly how you get degrees of capitulation. I
Hmm.
mean, you know, you're an investor until all of a sudden you're a trader,
Right.
you know, where you're panicked a little bit out there, and but that's actually what creates degrees of capitulation in here.
Hmm.
So, I'm looking at the S and P's,
I'll let you take this
and
screen if you want to take it.
yeah, I'm looking at the S and P's right now, and I have no problem sharing this one. So I'll close up this left side bar, and the first thing that look, I'm not a big market technician. So
Hmm.
I grew up around a bunch of quantitative arbitrage people.
Hmm.
So that's, by the way, that's what's wrong with me. There's a lot of things wrong with me, but if people don't even know like what quant arb
Yeah.
happens
I,
to be.
I
Uh,
never was on a date and a woman said, "Wow, you're into quant arb."
yeah, yeah. Yes, but on the weekends I am involved in volatility arbitrage. That's by the way, in Chicago, man, that'll get you far.
Yeah.
That'll get you good places in Chicago. Um, so the first thing though I would say to somebody that does look at technicals is this view, which I have on my screen right now, is like 9 months. That's not going to do it. Then you open up like 5 years and you're like, oh, okay.
Mm.
But at a time like this, when you're seeing like a trading couple of sessions that are pretty epic, you got to open up like a 15 year. And normally I don't like to go to this distance, but I think it'll keep you a little bit more sane on a couple of fronts. Number one, are you giving back some gains? If you're long the market, yes, you absolutely are. Okay. But the deer in the headlights, this is not a time for it. And that doesn't mean that you have to run to your 401k and exit the whole thing and, or, what every registered investment advisor is like, stay the course. Of course, they want to
Right.
stay the course. They want your assets under the management, right?
100%.
But
2%. 2%
there's,
to do nothing.
it's right. But there's nothing wrong with taking degrees of a portfolio off at
Mhm.
times like this, and of course, you'll try to time this perfectly here, but look, if you're not comfortable, if you feel like you can't take that heater, that it's it's even going to bother you into the weekend, take
Mhm.
off 1/3, take off half. There's nothing wrong with, executing upon whatever you think's going on. The one, I think, reality, because I know you're a little bit more like macro than I
Sure.
am. One reality, though, is they're trying to fundamentally change the economics.
Yes.
And, it's kind of a weird thing, but like, the Matrix over here is fighting back.
Hmm.
That's what this is. Like the marketplace is pissed. It doesn't want to change. It likes free money.
Of
It's
course it
had a
does.
lot of free money.
Of course it has.
Um, and then it's going to realize, though, that free money may actually come back at some point. Powell and them, they're going to capitulate. And
Hmm.
we all know that, there's a differentiating, viewpoint between Fed and now the Treasury and the admin. But right now, the markets are caught in that kind of crossfire between like mom and dad over there at the Fed versus the Treasury and of
Hmm.
course the administration. But this is a fundamental change of the way, okay, that the United States and really the world does business. And I'm not here to tell you whether, tariffs, I don't care whether you like them or not. It's not whether you like it or not. Like people are complaining in the chats, oh, this tariff
Right.
thing sucks.
Right.
Like, whoa, 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 whoa. Who cares? Like nobody asked, nobody needs to know that.
Right.
Like it doesn't matter if you don't like it. Like you're going through it.
Right.
And that's one thing. Like people always bring up like, political conversations in this front. I'm like, yeah, okay. Like I've become very like apolitical, especially like living down in like the Virgin
Yeah.
Islands for a while.
100%.
It really it opens up your eyes because you get like front row seats to watching the United States, politics kind of play out. And all this is again, if the way that you did business changed overnight, this fundamental change to the entire economic structure, well, this is the outcome.
Hmm.
What's the longer term outcome going to be? I mean, there's people screaming about this is inflationary. Okay. If that were true, I think that oil would probably react a little bit better than it
It
has.
probably would have. Yes.
This is recessionary, it's economic
Hmm.
slowdown, it's deflationary. Even though in the short term, some of the items may go up, overall, like, you know, in the end, the economy is supply and demand. And, you might demand your 98-inch Samsung TV, which I swear to you, I bought like a week ago. Unknowingly bought that like a week ago. So had to have the 98-inch one. Anyway, so that's supply and demand. Everybody's going to demand them right now, and like 2 days from now, it's like gone, poof.
Right.
Okay, and that's not inflationary. Even though like I have to pay 34, percent more. Yeah, but when nobody buys them, prices probably go down.
We'll go down. And
So
that
it's
is that yeah, that's the
oh,
next leg. That's the next leg, the story that is not told is that trade wars are inherently deflationary over the long term, and capital investment will be cut. We'll see a slowdown in consumer buying. So these are all critical. What do you got? Got a
by the way,
circuit
a
breaker?
message. Yeah, no, the messages
Oh,
just popped up in
just
here.
letting you know.
So, by the way, that absolutely kills me. I was talking about this morning when I was live. It kills me. There's nothing like panicking. Like, who sends a message like this on Thinkorswim? By the way, for those of you that don't know this, so I was Thinkorswim TD Ameritrade for the better part of 15 years. And one of the things like my group specifically did would be like send a message to Thinkorswim. That might be the dumbest message I've ever seen sent out. I like there's nothing like, hey, 7% circuit breakers. The circuit breakers do not exist in the last 35 minutes of trade. Okay. So when you come into the last 35 minutes of a trading session, for instance, if you're on Eastern time, the bell goes off at 4 p.m. Eastern, right? That's the close.
Yeah.
But the last 35 minutes of that, gloves come off. There are no circuit
Hmm.
breakers in the last 35 minutes. But like, even if you go 7% and you go limit down, what limit down means is if you lock and they'll stop the spiders and they'll stop the S&Ps and they'll stop the whole market. And it just marks time. Beep, 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 beep. And a few minutes later, they'll release the hounds again and they'll let you sell.
100%.
But breakers, last time we saw circuit breakers, though, with any real ugliness was the COVID crash. But it's different now. The breakers used to be overnight at instead of 7%, they were 5%.
Mhm.
So 5% used to be limit down overnight. They actually changed that now to 7% in the overnight trade. The first one to hit the breaker, if it happens today, is going to be looks like the Russell,
Mhm.
but that's almost neck and neck with the Nasdaq, and it'll happen very quickly. Okay, so what'll happen is we're down like 6.5%, and then servers will actually kick into high gear and actually sell us right into the
Mhm.
7% limit. Lock limit is, it's obviously serious, but so you go down 7%, they lock them up for a few minutes, and they release the hounds again. And then the next circuit breaker is like 13%. Where do they come
Mhm.
up with these like esoteric numbers? So I absolutely love that stuff though, like, because I was on the other side of this. Like, by the way, even when you work at the brokerage firm, like you still trade a ton, there was a period of time where I worked at Thinkorswim, and everybody that worked there did not have to pay commissions. It was absolutely spectacular time. But when we didn't have to pay commissions, nobody wanted to even work. We would just sit there and
Mhm.
trade all day.
Yeah.
So they they made us pay commissions. And then TD Ameritrade came in and bought us, and they said, you can't give cheaper commissions to the people that work here because that's considered benefits, and we
Right.
have to pack you on those benefits. And I'm like, these big corporations, man, killing me smalls, killing me
I got a real
smalls.
quick question for you before I
Yeah.
take off, and
Yeah.
that is, this came from someone in the chat, and it said, at what drop in junk bonds, i.e., the HYG, should we be worried about this keep going down? It's talking about high yield corporate bonds. This is actually interesting because AIG stocks under pressure today, which first time we've actually seen that happen.
Yeah.
High yields down, private credit's getting crushed.
Yeah.
FS Investments, FSCO has gone from 7 to 6. That's a private credit closed end fund pool of private
So,
capital, right? So like that stuff's starting to go right now. So
okay.
this is this is
Yeah.
interesting.
So I was going to talk about this during my session,
Yep,
and this is not going to be a nice, warm and fuzzy conversation here, but by the way, you're welcome to stay on as long as you'd like,
I
Garrett.
appreciate it.
Um, this is not a warm and fuzzy conversation. Look at the XLF, start there.
Mm,
The XLF is down about 6.5%, which is on the leading edge of the S&Ps. Then start to look down at the big banks. Forget about like small, forget about like credit. Um, there's risk in the banks. So what's actually happening right now is undoubtedly you've got these big banks. They're not just banks, they're also clearing firms like Goldman
yep.
Sachs. And I'm not picking on Goldman, but they're also clearing firms. Somebody's possibly blowing up here.
Hmm.
And that risk of blowing up, what blowing up basically means is you get this trading firm that the risk limits have been hit, and they start to, expand the risk limitations as far as they can. They still hit those, and then margin starts to expand out. They're going to have to liquidate some positions. Um, those types of positions can never be quiet. They're never quiet. Someone always 100% knows. And it's not like it's like insider trading. If I worked at Goldman Sachs, okay, because I've had very, very close friends work at Goldman in their trading unit, which their top tier trading unit only has a couple people in it,
Right,
like literally handfuls of people that really control capital. They're constantly looking at what's going on in the clearing firm portfolio of other people's
right.
stuff. And the reason they do that, if somebody's blowing up, they actually start to trade against it. And that might be what you're seeing inside of some of the banks right now,
Yeah,
is that you get these people that are traders looking at the risk of other firms and assessing, oh, they're screwed.
mhm,
So we are at a little bit of a tipping point. It's why like junk doesn't really surprise me,
right.
because it's illiquid paper.
Hmm.
And anytime you get stuff that's really illiquid, the move just gets exacerbated by the fact that there's not really a good two-sided market. The disconcerting area, consumer credit obviously is a big one, but the disconcerting area is when you see a Citi, Bank of America, a
Hmm.
Morgan Stanley, they're all down like 8%. Does it mean we're in a financial crisis? Absolutely not. Like that's not my intention. But okay, it definitely means they're going to take a financial hit.
Hmm.
So this don't confuse, what you're seeing on the screen with a financial crisis. It's not a financial crisis. They're going to take a sizable financial hit, and that would basically be right to their bottom line. Oh, such and such lost money. They got over their skis. we're going to take, a $600 million write down on that portfolio we blew out of their stuff. And it's one of the reasons I think that you're seeing some of those underlyings down considerably.
So
Yeah, go ahead.
one quick question for you on this one. So again, everybody, if you have some time this weekend, go watch Margin Call, because that movie is basically what Don is explaining on how people liquidate positions. But Don, I did want to ask you about one thing. As I've noticed, just kind of historically, crises, these events with banks, it's usually always something like the safe asset that actually causes it, right? So like housing was 2008, and long-term capital management wasn't anything completely over the top. But, there was leverage, there was effort. Everett's or something like that capital, which blew up because they were trading very, very high leverage on a very small spreads on the difference between the euro and the Swiss franc, and the peg got knocked out. So then you have the basis trade, right? And this
Mhm.
is something that people are starting to be a little worried about it. So people understand. I was going to explain this before you came on, but the basis trade is effectively an effort to try to exploit the difference between a treasury futures contract and the underlying bond. Now, it sounds a lot more complex than it is, but basically traders will go long the bond and they short the futures, and they're
Right.
just
Real
trying to
easy.
get a profit as the two things converge at settlement. But here's the problem. They leverage it up like 50x. So a 10 basis point spread can generate about a 5% return on your equity, but the risk is massive if the spread widens.
Yep.
And
And
and that's what
that's
we
been
saw in
done. Yeah,
2020. Good.
that's been done time and again.
Yeah.
It's basically any type of basis trade.
Yeah.
If you guys think about it, like I used to do some basis arb, like called the 1-5, which is S&P 100 against the S&P 500. Like imagine you're trading and you see this gap in trading between prices.
Hmm.
Okay. You buy what's lower, you sell what's higher, and eventually they converge on expiration, right? That's the kind of the way to think about it. But you're trading really, really narrow margin in there. So then what you basically do is you take that narrow margin, and you just amplify your leverage. Where that's where like the Fed comes in and they give you free money at the discount window. You're like, oh, I want all you can eat.
Hmm.
And then they just lever up, because if you can borrow money for like next to nothing overnight, and we did this for years, they borrow money for next to nothing overnight, and they just carry these immense, spreads, but for very little. Then you get a day like today, and that little like spread just explodes wider. So I actually have a friend that's in the crisis seeking side of the business, and he trades the opposite of a lot of the banks. So like a day like today, he'll make a living for the next, decade.
Hmm.
That's exactly what they do, is they use derivative contracts and take the opposing side of things. But yeah, that's so we're starting to see a little bit of that kind of break apart. And the HYG, which is again, the HYG is well known to me as the product that does absolutely nothing until it implodes, right?
Hmm.
But to give you some scale in the matter right now, this is the move right here that we're seeing, which is like pretty nominal. It's like a little dot on the screen.
Hmm.
This, okay, over here, that little monkey right there, that's 2020.
Hmm.
Okay. If you look, 2022 is kind of wild. That was long and drawn out. But these moves that I'm drawing, I'm like trying to give you scale. It's like
Right.
this big. And
It's
then
a
it's like,
year. That's nine.
yeah.
It's at least 9 months right there.
And this is like it's pretty negligible at this
Yeah.
point in terms of like, again, on like a really short term chart, you're like, holy crap, we're going in. But then you open up like 3 years and you're
Right.
like, okay, it's not that bad. It's just like kind of skinning the knee right now. Um, but what is a little bit more disconcerting is that the banks themselves are coming in pretty good. And any crisis in financial markets ends up as a financial crisis,
Right.
because the banks are gonna take hits. And that's like the one thing that people don't understand. The retail side, like if you have an account at like Charles Schwab and somehow you circumnavigated your margin requirements and you lost more money than was in your account, there's no insurance for that. Like they take a hit. Had it happened to me at Think or Swim, you know, but it happens all the time at big banking firms, because the banking firms are extending these professional trading firms, okay, a whole lot of rope, just enough that, some of these firms do get themselves in trouble from time to time. and it's usually highly leveraged positions. By the way, every one of those firms that you've spoken of, generally in recent years, okay, they're all run. I'm going to pick on Gen Z for a second. They're all run by Gen Z.
Yes.
Like I'm always talking to people. I'm like, oh, you remember back in the financial crisis? They're like, dude, I was in middle school, and I'm
Right.
like, oh boy, we're screwed. We're screwed because
Right.
if that's who's running the hedge fund out there, I'm like, so what's the riskiest thing you've been in? They're like, man, I was involved in COVID, and I'm like,
Yeah.
oh boy,
Yeah, I had a friend who launched a very large fund, and it was $800 billion, or 800, yeah, $800 million, forgive me. They were on their way to a billion. And I called him February 21st, 2020, and I said, "This is the first time ever that the signal that we have built has ever gone negative. You better prepare." He said, "We're market neutral." Well, you know that nothing is market neutral. 3 weeks later, he called me in the middle of the night and he said, "It's gone." I said, "What's gone?" I said, "The fund." He said, "Yeah." I said, "He lost $800 million." He said, "No, we lost 1.3. We were leveraged."
That's
If they
South
would have,
Park.
if they would
It's
have, if it really
it's
was,
gone.
but if they would have lasted another 2 weeks, they would have been fine, right? Because the Fed
Yep.
stepped in. But they had their margin call around like the 14th or 15th, and that was that. And you're right. I mean, there's still a lot of no matter how many times we see this happen, it's still a new group who says this time is different, and we're gonna see funds blow up soon, and we're gonna see some Ponzi schemes exposed. That's what we're gonna see in the next couple of weeks.
Yeah, you know where that they're holding it together right now, but like the crypto marketplace,
Mm-hmm.
I'm literally looking at some of the crypto ETFs. And I'm
Yep.
like, ooh,
Yeah.
I'm gonna look to short something in the crypto markets. And you can't short Bitcoin, or the Bitcoin futures are
Sure.
huge. But I'm probably gonna look to short some of this because what has not happened yet, and this is unusual, once they started listing like crypto products on the same platform as, equities and futures,
Mm-hmm.
everybody thinks it's non-correlated, but it will be correlated. It's kind of like gold.
Right.
Okay. People are like, why is gold down so huge today? Because people will have to liquidate gold positions to be able to finance holding other
Correct.
positions. I'm surprised that crypto's not feeling it right now. And that's where I think that some of the ugliness could actually play out this time. And it's I'm not, anti-crypto at all, but I am definitely concerned about that product
Yeah.
going down substantially, even though it's up today. People are, no, man, they're
Well,
buying it. But it's bottom line, they're going to sell it if they need the money.
so let me ask you a question, because when I see events like this, and this will be my last question, and then I actually have to go work out. I promised myself I was going to do that today. But you're bringing up a really good point. If we go back to like 2008, and we're not comparing what's happening right now to 2008, but the point was, you had like the Michael Burry situation where Burry could not get any of his stuff marked to market, and resultantly like his shorts were not coming through because they were not marking the bonds to the market. Is that I don't know the crypto market enough. Does that exist in the crypto market, or are there things that like you have things that are being lent out, that are being lent out, that are being lent
Yeah.
out, and
Yeah.
they haven't fully admitted that, like, they don't know where some of their crypto is? I don't know the answer to that.
They have no idea. So
Yeah.
there's derivatives on derivatives and derivatives in the crypto marketplace.
Right.
Crypto marketplace is beyond the Wild West. I don't
Right.
even know what to call it. It's no one has any grasp, any grip on what the derivative side of it looks like, because
Mm.
there's so many of these like oddball exchanges that pop up that are placing derivative trades. The one, I think, saving kind of grace of that, it's not that big yet. So if all of crypto
Right.
like imploded and it lost, 50, 60%, the damage would be not, completely like systematic, not systemic.
Mm-hmm.
Systematic just basically means it's going to spill over, domino into the markets, but it's not going to be systemic where the whole thing is going to go down. That's important to
Okay.
know. But you're right. The thing is about like some of the assets that happened, in 08, they weren't marking to market. It was very hard to price things. I was just having problems with that earlier in the S&P market. I was having
Mm-hmm.
a tough time actually trading even S&Ps because the bid offer spreads got a little wide, got a little crazy. Um, So Burry was actually trading in some really illiquid stuff. The thing is, though, in like crypto, there is a pretty consistent marketplace, but it's thin. So like the price will just drop so fast. People's
Hmm.
head will spin. It'll continue to trade, but there's no it's again, it's a very small window with just a fire hose being shot at it. And that, becomes disconcerting. By the way, you're speaking of the financial crisis, just to show you, um, there is one very concerning area.
As you were,
Even,
yeah,
yeah, go ahead, but
as you're noting this though, like yeah, like Coinbase isn't going to give us any clue about that because Coinbase is so closely related to the performance of the S&P 500. It's
yep,
basically chart on top of chart, so we're not going to know if there's an underlying issue in crypto until it happens. Like
you know
you're going to
what?
wake up
And
one day.
I likened actually the coin. Okay, this thing's getting whacked back a little bit today, but this is one where I would have anticipated it would have fallen harder
Hmm.
because they're an exchange, but they also hold, but they're also a brokerage firm, but they're also this, but they're also a market
Right,
making firm.
right,
Like they're everything, and that's
right.
that's why actually the Securities Exchange Commission went after them. There's conflicts everywhere. This is one though that it's great that you brought this up because this is going to be phenomenal to watch.
Right. Meanwhile,
Because
like CME
yeah,
Group, CBOE, they're all at all-time highs, which
yep.
is wild to see.
Well, this is good for business.
It's great for business,
Yeah,
but Coinbase, you would think that it's equally good for business, right? But
until they're
oddly
holding
enough,
risk.
but right, but no, but oddly enough, Bitcoin prices haven't moved. They're still at 82,000. Nothing's, people aren't doing a whole lot. So, you're seeing,
very I'm very leery of that too. And
yeah,
I can describe exactly why a lot of things are moving the way they're moving on the screen. Like gold, okay, sorry, people are selling gold. Why?
right.
Because they need to raise capital.
Yes.
Bottom line, they need to raise capital. That's why they're selling gold. Everything else on the screen makes quite a bit of sense. Like volatility, okay, that's where I live. That thing should be shooting through the roof. Most currency moves make a lot of sense. It's ironic today that all of a sudden, yesterday we had to get out of the dollar, but today we're like, no, the dollar's the greatest thing. Because in the end, and I always tell this to people, in
Yes.
the end, okay, when it comes to currency, and forgive me for those of you that are living in other sovereignties, our crap is better than your crap. That's where you're gonna go. You're gonna go to the euro. Oh, hold me some euros. You want some Chinese, the yuan. Oh yeah, I gotta get me some. No, okay, they're not buying rubles anymore. There's nowhere to go when the real fear hits in terms of currency. So of course they go back to the dollar
Yep.
because I mean we spent the last 50 years in the United States building it up that people are like it's not going to be the reserve currency. Really, where are you going to go?
Yep.
I always ask that question. Where are you going to go? The Aussie dollar, yeah, which is getting annihilated, by the way, today.
Well,
So
that's the interesting thing about this. You have this sell off and then the flight back into the dollar. And typically, when there's a flight back into the dollar, that signals there's something wrong liquidity wise, because again, the bulk of the debt is paid off in the debt instrument that is the dollar. Don, I'm going to let you go.
yeah, yeah,
All right, great conversation.
I'm gonna keep right on chugging over
All right,
here.
thanks so
All right,
much. Bye.
fantastic. Thanks, Garrett.
Bye.
So let us continue. So obviously I have now control of the screen and you will listen to every word I have to say. Now, the marketplace right now being down some 250 handles in the S&P is a 4.5% loss. Not dissimilar to some of the price action that we saw yesterday. This feels, though, today a lot more serious. It's still rather early in the day. Okay, we've actually attempted a multitude of rallies throughout the course of the day. I would not discount, okay, that ability to see a substantiated rally at any point today. I wouldn't discount it. Does that mean it's coming? Absolutely not. And that's important. And by the way, I'm just reading the chat because what I'm going to try to do in the next few minutes is answer a couple of questions. Um, as I said that again, okay, would assume that there's going to be some attempts at rallies. Things have definitely quieted down from earlier. One thing I'd like to show you, this is a positive. The S&P futures, okay, at many minutes even at some of the lows in here, you can see the absolute lows, but some of the lows, you're doing 3,000 contracts a minute. Trades getting a little bit tired and so forth. Okay. We have one very serious situation to pass through, okay, before the market closes today, which I'm going to describe. Okay. And even if we rally at some point today, just going to throw this out here, even if we rally, one of the things that I'm pretty good at doing is kind of handicapping what's going on kind of in the middle of volatility. One of the reasons I'm like, we called an audible and, had Garrett come back on, myself come back on. But one of the things you're going to pass through late in today's trading session, even if we start to rally back up, we're going to have to deal, okay, with redemptions somewhere in that last hour, 90 minutes of the trading session. Okay. Again, we're going to have to deal with redemptions. For those of you that have no idea what a redemption happens to be, as I said, even if we're rallying, redemptions are this. Okay. And I'm kind of curious, and I've got broadcasting this into multiple rooms. How many of you, okay, literally today decided to actually bail a portion of your 401k? Okay, come on, people. Admitting it's the first step. Just a yes or a no. Why for yes and for no. How many people here today started to bail part of their 401k? A lot of people. Okay, it's enough. YOLO. That was an awesome answer. Okay. All right. The majority like are no's. And by the way, it's okay. Like I'm just trying to get a feel for some of that. Okay. That's awesome. Somebody said they hedged theirs. That's great. Um, the issue with that is the way that funds work. Okay. It's absolutely archaic the way that these funds work. So I'll give you an example. Vanguard 500. Vanguard will look at their redemptions, but they have basically a period of time. Like for those of you that have ever wired money, if you've ever wired money out, they basically say, okay, this is the cutoff time. Here's your cutoff time. After this time, there's no more wires being sent. Hasn't anybody ever thought to themselves, that's the most ridiculous thing I've ever heard in my entire life? We have to cut off wires every single day in the banking system. Okay. It's just, they're trying to control us, man. Guess what? All your funds do the exact same thing. If you get like the redemption in before a certain time, and it says it on your 401k site, I know because we used to administer this, like we used to run it at Thinkorswim and TD Ameritrade. If you get that in before a certain time, what it basically does is the computer program waits to a specific time. Everybody's a little bit different. They aggregate it all. They go, okay, there we go. We have 30 million to sell. And then they just go into the marketplace and spit out the pieces. What that basically means is they come into the live market, okay, and they whack 30 million, okay? It's a lot more than 30 million. It could be billions. They just sell it. And when it's like a Vanguard, the Vanguard 500, okay, is basically like the spider. So it sprays liquidity into every product. It would be wild though on a day like today. So I don't know. And everybody tries to handicap this, but we don't know exactly. It doesn't necessarily, it's not like always a market on close or anything like that. But in the last 90 minutes of the trading session, even if we're rallying, okay, there's a bit of sell side activity, okay, that is going to be there. And of course, the next question is somebody already asked, how do we trade that? And the truth is, okay, you can hop on board for a ride, but it ain't easy. Okay. And in a day like today, you can take a look at volatility, and I'm just going to show you something. The reason it's so difficult to make moves today is that the volatilities are still sky high. It's the single biggest problem with trading sessions like this. We are trading, people are like, oh man, look at the VIX, it's at 40. Hold me. I'm not going to hold you for a 40 VIX. But today, the remainder of today, we're at like the equivalency of like an 85 VIX. And it makes it so hard to want to take positions. There's days like today, like, look, today I only have 3 fills in this account. I have a bunch more fills in Tasty. I've been actually trading pretty actively here in Tasty today, but overall, I've only done 8 or 10 trades today. Okay, that's it. And my reasoning behind why I've done so few trades is the volatility is high and it's making it really hard to execute. But, the idea over here is if you wanted to take a shot, okay, just a pure unadulterated shot, okay, and you're like, oh, I think we're going to sell off into the close. Oh, this is terrible. There's like no strikes down here. Look at this. Okay. You do something, wild and woolly. Look, okay, that's a spread trade. So it's a spread. So I'm buying the 512, selling the 505s, but you have to close that before the close. Like if you thought we were going to sell off big into the close, okay, this is a $7 spread, but you only pay $1.58 for it. You just close your eyes and go, I'll see you at the close. Okay, I'll see you at the close. That's that's the kind of thing that can be pretty effective in a market like this, where you're just closing your eyes and placing a spread, but you have to close this thing before the bell goes off. Okay, I don't care win, lose, or draw. You got to close the spread. It can make as much as $7. You're only risking $1.66. But if you think that the sell side is going to come back in and crush the close, okay, to me that's the way I would execute upon this. I think that it's the only easy, only reasonable way to do that. And I love what somebody said. Can you do it in the SPX? You can, but you got to realize in the SPX, because I know everybody likes the XPX because it's a cash settlement. There's also XSP, which is a cash settlement version, but the XSP, the markets, the bid offer spreads, they're a little wide, a little funky. But you could do it here too. Like if you were scared, okay, because this is a cash settlement instrument that's the same size. Okay. Like if you needed a hedge, just get me through the remainder of the day, Don. Hold me. Okay. But if you were really scared, I don't usually trade this product. Okay. But today, like, look, the bid offer spreads in here are really wide. But I kind of know what the price should be because I was just looking a moment ago. But if you're really like intimidated by what could happen into the close, like this is a $5 wide spread, okay, for $1.50, this price, okay, is reasonable. And okay, this thing does settle to cash. So this one, you would not even have to close. Okay. You would not even have to close. This, I'm going to tell you right now, this kind of a marketplace in here, right? On the retail side, you got to be careful. Look, I've been trading a lot of years. Okay. And I didn't have to place a lot of positions. Okay. It's not a popular thing. I do extraordinarily well in days like this. Okay. And the reason I do it is I'm positioned for it. Like I'm not sitting here banking on volatility. Okay. But I'm always positioned for spikes in vol. I'm a crisis seeking trader. There's not going to be a day like this where I'm not making $20,000, $30,000. Not a day like this. And again, I'm well positioned for it. This account, is up 11 grand. There's by the way, I have a ton of accounts in here. Okay. Accounts over here, I'm up like 13 grand. I did much better yesterday than today. Because I put a position on today that's taking a little bit of heat. But it's positions like I'm showing you here, okay, that are, if you will, like the right thing to do, okay, in a marketplace. And this is like, you're just taking a stab at it. You're taking a stab at it. And I don't mind saying that, like positions like this, if we go down, okay. By the way, I'm actually kind of curious if I can even fill in here. So forgive me as I try to get filled. See, I'm trading a $1.28, the mid $1.29. I think this thing is really worth about $1.30. So I think that spread's worth about $1.30. Anyway, this is the close your eyes, okay, and risk $130 if we crash into the close. That's it. That's what the trade happens to be. And of course, Don's getting because I'm not filling on here where I want to fill. And obviously the marketplace is flipping around a lot today. Okay. I'll just leave that in at that price. And for those of you that are in, I'm going to create a duplicate order. You're in our main chat room. I will actually post that trade in here. Okay. This is a cash. Okay. So this one, literally, I just bought one in there. It does not have to be closed. Okay. This one you can just ride off into the sunset. We closed between 514 and 509. Okay. You're a winner. How much do you actually make in here? It's only $365. Now, it's the person that brought up the SPX that brought this up, and it's fine if you wanted to do the SPX. Okay. But the SPX, people, this is the mother of all products. Like in the SPX, you step up here, you're stepping up to, put on the big boy pants. Here's another one where you can take like these tiny little spreads. Even a trade like this, like a $1.85, but you can make, a couple dollars from it. I just the SPX, I don't like displaying this much on a day that the S&Ps are kind of getting rocked. Again, in no uncertain terms, and I want you guys to understand, okay? You don't know what this marketplace, and this is okay. You don't know what this is going to look like into the close. We could explode higher. Somebody inevitably is going to want to take the same trade that I just did in the bearish side. Maybe you want to take it on the bullish side. That's okay. But use the proper product, okay? And just use the spread, because the spread is going to mitigate all that 85% volatility risk. So what people are going to do, which is a huge no-no in this market, if you buy a call, you're paying $2.42 for air for the next 2 hours. That is a premium rich product. Okay. That's a really premium rich kind of product over there. That's not going to be good, because the $2.30, you're going to have to move up, okay, about $3 just for you to break even on this trade. Like, okay, we're down 22, whatever, that's easy. All right. But that's a stretch. In any marketplace, you're paying so much for the volatility. So all that volatility is going to collapse out as you know, come closer. Oh, these options are moving right now. Holy crap. The volatility is all over the place. So I can tell you one thing. And so just the last few minutes looking at the options here in the spiders, we are greatly destabilized right now. Okay. Gamma's flying all over the place. And what that means, okay, it's exactly what I'm saying. As we turn the corner here into those last hours, okay, I'm not the only one thinking about this. Not the only one thinking about like, what's this going to look like into the close? Okay. People, that's not a rally. That's the dynamic of sell side activity. That's not a rally. Okay. It's sheer madness when you look at it and you're like, oh, it rallied by 50 points. It's not a rally. Okay. It's the dynamics of a down move. You have to have a bid back to actually sell again. That's just the way it's the dynamic of hedging. There's actually what they call dynamic hedging. And that is, more often than not, trading firms have to hedge into the dynamic of the marketplace. But then there's like a recoil effect. The higher the volatility, the higher the recoil kind of effect. And you're getting a lot of that right now. But when you zoom in and you look, this is a 1 minute candle. And I just want to make a quick point. When you zoom in and you start looking at 1 minute candles, and we're throwing off ranges, okay, like that, that's a 15-point S&P candle in 1 minute. Do you think 50 points matters? Okay, 50 points doesn't mean squat. It's a 15-point move. Like if you're looking at average true range down to the minute, okay, that's some big boy range. You're probably an average true range here on a minute to minute basis of like 8 to 10 points. So 50 doesn't mean anything. Again, it's really tough to kind of handicap some of the closes. The only thing I can tell you, okay, for sure, is the financials. Okay, you're going to want to watch these very carefully into the close. Why? Volatility already popped. Surprise, volatility's higher. Vol already popped. What's so interesting about the financials? Okay. Because if somebody's going to blow up, it's going to be over the damn weekend. That's when they're going to come out and be like, I'm cooked. You'll find out real quick. If somebody's actually going to get cooked, you're going to see it in today's close. Okay. Because they're going to have to relinquish whatever the positions are over the weekend. We're going to come into Monday. Things will still be crazy. So you got to watch financials. If anybody knows anything in the financial world, you're going to feel it in the financials themselves. I mean, they're already down 6%, but that's going to be well worth watching. Another one that's pretty interesting today, of course, is the energy sector getting absolutely decimated. This is where I say it's deflationary, heavily, heavily deflationary at this point. All right, let me, answer a couple of questions in here. There's a few positions that I still have on. Okay, one of the positions I have on is EWG. This is the German ETF. It's up about 72%. It is what it is. I'm going to leave that one alone. The other one I have on that's breaking even right now is Costco. Okay, it's just an in-out spread, and it's kind of ironic. You're like, why is it breaking even? Costco's down huge. Costco is down huge, but the volatility expansion is so much. Okay, that the Costco trade will be fine, but the volatility expansion is so much. It's like boom, the trades can't see P&L. It's like today, people are like, are you going to sell premium? Sure, I'll decide that in the last like 2 hours of trade. I am going to sell some premium today, right? I'm going to step to the plate and sell some premium. I'm actually going to put on another Christmas tree spread. Let's get nasty. A little nervous, okay, about that. I'm going to tell you right now, okay. But none of the money, like if I put on sell side positions, none of the money is going to be made today. I sold premium yesterday. Okay, the premium I sold yesterday is losing today. Didn't matter if it was a call or a put. Okay, I'll show you guys something really interesting here. I sold in another account. Okay, I actually sold a call in this account the other day. See these 6,200s? Talking about this morning. I sold this call 6,200. Look where we're trading. We're trading at 5,200. It's not even up 50%. You're like, what? How the hell is that possible? Like if you look at my activity in here, you can actually see exactly, I rolled some stuff in here too, but these 6,200s, I just put them on, okay, not too long ago. And they're not making money because the volatility is expanding so large that you can sell calls and you won't even make money on. Like huge, huge stuff. Okay. Um, there was another great question here, and I am going to answer this one. The VIX. So I have a VIX trade on. By the way, this VIX trade, okay, I've had dozens and dozens of emails about my VIX trade today. And the reason I've had dozens of emails, I didn't just do the VIX trade while on TheoTrade. I did the VIX trade while I was on Charles Schwab TV on Wednesday, not knowing that any of this was going to hit. This is the exact trade that I talked about on Charles Schwab TV. We even sent that out like in an email. The trades that I did a trade, in the VIX. And so here's the thing: this VIX trade is deep in the money. Okay, it's 11 days left, and it's $5 wide spread. You're like thinking it should go for $5. It's only going for like half that. It's like 268 because the VIX, this underlying, okay, right there, that's not what these options are based on. These options are based on the volatility futures, which are trading at 31, which means that this option right here, okay, basically we're at 31. That's the at the monies, the 31s, not the 40s. So there's already reversion to the mean, meaning that, okay, crap is hitting the fan out there, but they're already pricing that 11 days from now, we're going to revert back down to about the 31 level. The volatility futures are really the underlying out there. Okay. Again, very interesting stuff going on. Speaking of volatility futures, we're in one of the larger, backwardations in modern history. I was mentioning that. I am going to be quite curious to see where we are by the close of today. Again, there's some two-sided trade. We're kind of hanging out in this range right now. We're going to see where this thing actually closes at. Bear with me here for 1 second. All right. I'm just making sure. In our schedule over here. Apologize about that. So as we actually, forge closer to the close, okay. Look, sit tight. If you want to take some positions, okay, use spreads. I would say use spreads. Like if you think this is going to rally back up on Monday, like look at stuff like the energy sector. If you are going to do trades in here, use spreads. Like the energy sector, could it rally? Okay, absolutely. I mean, look how decimated it's been. But if the energy sector is going to rally, you're going to have to be very, okay, smart on how to actually take these trades. So we're trading at like, 80 and change. First thing I'm going to look at, it's not even delta. I'm like looking at the implied volatility. Okay, there's a huge amount of what we term skew in here, and it makes it so difficult, okay, to be able to take positions like this. Like, look, this is a $2 wide spread, and they're trying to charge $1.09 for it. That's crazy, crazy expensive. Okay. They're like, why is stuff so expensive? Because the volatility is just, it's distorted at this point because of all the movement in markets. Like volatility, the skew is huge. Like in the energy sector, I'm like literally telling you, I'm like, oh, I'd love to get bullish in here. Okay. But I just can't. And a back spread would cost me a fortune. It's just, there's times where like I want to take positions and I'm like, oh, that's not going to work. I look at stuff like Nvidia. Okay. Nvidia doesn't have earnings coming up. Nvidia could be an easy shot back to 100 in the midst of a rally. What kind of a trade can I place on here? Well, the exact same thing is going to be true, okay, in Nvidia. Nvidia, if I try to place like a $2 wide spread, okay, or a $3 wide spread in this case, knock that down to a $2 wide spread. Like, look, they're charging the exact same amount in Nvidia for a $2 wide spread as they are in the energy sector. You're like, oh, that's pretty interesting. It is interesting. Okay. What I'm trying to allude to is it's like not as easy as you think to be able to take like a bullish position, even in a marketplace that's getting smoked like this. You're like, but we're going to rally over here. Okay. And you can't do butterflies or broken wing butterflies. Those are terrible trades at a time like this. I'm not trying to pick on anybody, but I'm definitely picking on you, because the sale of premium is also going to have a lot of skew in it. So you're kind of left, kind of between a rock and a hard place. Like there's times like this, I'm like, oh, we're going to rally. Like I can feel it. I can see it. We're going to rally. Okay. Even if we sell off a little bit later today, like I can feel like a rally, in the making over here. And yet it's not an easy achievable position. It's one of the reasons though that uh, I am kind of backed off a little bit here on what I'm actually executing. Gonna let this kind of play out a little bit, let things kind of mellow out, and then I'm going to be jumping on it. Even like what we call call ratio back spreads, the volatility is so high. Like I was looking at a call ratio back spread in Apple earlier, and just like 13 days out, just to make an easy example over here. This is a call ratio back spread. Okay. Call ratio back spread. And if I analyze the trade, bear with me here for a second. I've got a bunch of positions on in here, but hide position. Okay, get rid of that. This is call ratio back spread. And right now, okay, if you look at the slices, right now, this is where Apple is trading. It would have to get all the way to about 211 just for you to really kind of break even on the trade. Okay, you start looking at that on the chart in Apple, and get back to 211. Yeah, definitely. But that's a lot to contend with, and it's going to have its earnings, okay, coming up. But this trade is also going to tie up $10 of margin minus the dollar you collect. It's going to tie up, like $900 of margin, 880 in this case, okay, of margin. It's again, it's tough. That volatility is really, okay, kind of wreaking havoc on there. All right, I think I've actually run out of time, and I am going to be turning it over in the main room to Brandon Chapman. For those of you that are in the Theo Live Market Masters room, each and every one of you, by all means, join us on a day-to-day basis in the main TheoTrade room. We can actually post a link for you to enroll for that now. Okay, and we will post a link here momentarily for that. Let me make sure that the link gets in there. So we'll post a link for that. Obviously, this is much more Garrett's room than mine, but really wanted to come on today, talk a little bit about volatility. Okay, look, the opportunities are coming and they're plentiful. You got to stay intact though at a time like this. There's no reason to jump out into traffic because this is like, trying to run across the 405 freeway right now. If you guys have no idea what that is, okay, it's not good. There's no reason to come out and play in traffic right now. The volatility is exploding and let things kind of calm down, right? Most retail traders don't do well in traffic like this, and it's okay. So what we do at times like this, you just very carefully pick your entry point. You do a spread, okay? Relax a little bit about it. I know that the S&Ps, look at this from lows, they traded from 5136, okay? They're up 70 points right now, 70 points from basically when I kind of started this session. And at the same time, I'm going to tell you, okay, not much of a rally. It's not much of a rally given the fact that you're down some 4%, and we still haven't seen what it looks like, okay, when we start to hit that redemption kind of category in the day. So there's still a lot of volatility to play out. This is what I say, like a lot of time left on that clock. This is we're not even down to the 2-minute warning, people. A lot of time left on this clock, a lot of movement left in here. Hope you guys kind of appreciate it. And again, the main room, I'm going to turn it over now to none other than Brandon Chapman in the Theo Live Market Room. Thank you guys for tuning in today, and we'll be back at it on Monday. Brandon Chapman, it's all yours.